I'm Alan Kenny, Editorial Director with REIT.com, and we're in Washington, D.C. for NAREIT's Washington Leadership Forum. Joining me is Mike Graziano, Managing Director with Goldman Sachs. So Mike, one of the more interesting trends in the REIT space recently has been the number of companies pursuing investment grade ratings. Yeah. What are the implications of that for real estate?
Sure. Well, for many companies, it makes an awful lot of sense because you have instant and immediate access to capital when you have that unsecured rating, particularly investment grade rating, and it also has carries with it a reduction in the cost of capital in a pretty competitive world on the acquisition front and on the return front. You know, having access to capital and having a lower cost of capital are pretty important, valuable weapons for the public REITs.
And 2 months into 2015, what are your thoughts on the activity in the equity market so far for REITs?
Yeah, it's interesting. I would have made a bet at the end of the year, and I would have been wrong, that we would have seen in the new year slow leaking, if you will, out of the system as the economy continues to recover and you see the investment universe move to more of a risk-on trade and away from some of the things that have been so attractive to investors on the REIT front, security of capital, predictability, real cash flow, and I would have expected a nominal small tick up in interest rates, and as that capital sort of leaked a little bit away from the REIT space into more of the risk-on trade, you know, I would have thought that you would have seen, you would have seen that not only the movement of capital, but a slight downtick in multiples, which wouldn't have been all bad because the very things that cause that to happen would also cause the underlying EBITDA and FFO of a lot of the companies we work with to grow. So it wouldn't have been a bad scenario. This would have been sort of more of an even keel scenario than we had seen. And that had been completely wrong because no one, at least myself, didn't predict that oil prices would be cut in half, interest rates would dive even lower, and REIT prices would move even higher. But indeed, that's what we've seen. And we've seen a little bit of a moderation of that over the last 2 weeks or so, but it's certainly been a surprising start to the year, and I think a welcome one for REIT management teams, which continue to look forward and use that cost of capital and access capital to grow their businesses.
Let's talk deal making for a second. M&A, anything on the horizon there?
Yeah, that's a prediction that I think has come true. You know, it's been a very quiet M&A market on the heels of the financial crisis for the last 3 or 4 years, and starting in 2014, you really saw folks having already repaired their balance sheets, having raised the capital that they needed to be in an offensive position. I use the vision of everybody opening their shutters and being really more on their forward foot as opposed to on their back foot. And you saw a lot of dialogue at the end of 2014, and a lot of transactions start to get announced. And we had predicted that we'd see even more of that in 2015, and to date, that's been exactly true. There is an awful lot of dialogue going on in the space right now across all asset classes. Dialogue does not always equate into transactions, but I think you are going to see a pretty robust M&A environment in 2015, and there's a lot of people thinking through strategically where they want to be in the next 3 or 4 years, and a lot of that dialogue taking place.
Thanks for your time, Mike.
You're very welcome.
And for more on this and other REIT news and analysis, be sure to visit REIT.com.